Welcome to the Rule Classroom Plus. This is Steve Barton, and today we're going to have a special discussion between Joel Litman and Rick Rule. We're going to dig into the big drivers behind gold and equities, and you don't want to miss the insights these two are going to bring to the table. Gentlemen, thank you for your time, and we look forward to this discussion.
Thanks, Dave. Hi, Rick.
Pleasure, sir. And Joel, special thank you for your participation in the Natural Resources Investment Symposium in Boca Raton. I enjoyed your presentation. Also, a shout out to the fact that you weren't a hit and run guy. You didn't retreat to your room after your talk was done, but rather hung out with the attendees, which is what I and they expect. So thank you for that.
Yeah, this is the difference between an online only versus when you can actually meet people in person. And no, I loved it. I love your conference. It's fun every year. You. It's great. I hope you have me back next year.
You are scoring very, very well in the attendee evaluation forms. As you may know, irrespective of how well I think somebody did, if my attendees don't think that they did well, I allow them to speak at other people's investment conferences rather than my own.
Naturally. I wouldn't have it any other way.
Yes. It was a fun conference. I can't wait until the next one. Okay, let's get right into it. We're going to talk discussion style for a dialogue for about an hour or so. Maybe start with opening thoughts. You want to start us off, Rick?
No, I want Joel to.
Okay, Joel, you want to start us off?
I still feel strongly about the title that I used at the symposium, which was Goldilocks for gold and stocks. That means U.S. stocks, though. The data we have is a global database of 30,000 plus companies around the world, including 6,000 in China. Which when you add up all that research, you can see why, because of every other country's utter mismanagement of their finances, you have every reason for central banks and people in other countries to be buying gold, which is good if you're a gold bull. At the same time, we see data that says U.S. corporations, the S&P 500, the S&P 1500, are fantastically strong from an earnings standpoint, from a corporate credit standpoint, and also should do very, very, very well over the next several years.
Okay, Rick?
Well, I'll start by saying that I engage in valuation discussions around natural resources and conventional financial services. There was a time in my youth when I believed that my success as an investor in natural resources would translate to intelligence across the economy. I proved conclusively to myself that that was wrong. So I don't want to engage myself in a valuation discussion around industries I don't understand. I'm just coming off an interview I did where I explained to my interviewer that I could barely pronounce, never mind spell, NVIDIA. And I didn't want to opine as to its value or as to its earnings prospects. It would appear to me, partially because I listened to Joel, that if you look at indexes like the Russell 2000 and the S&P 500 below the tech greats, that valuations relative to historic earnings aren't excessive. One would need to understand the competitive aspects of those technologies to understand whether or not the tech greats are overvalued or undervalued. And given that I can't pronounce or spell the businesses that they're in, I'm loath to opine. I am personally concerned about the fact that we've gone for a very long time without a real recession. I'm not an economist, and that isn't a discussion or a remark centered just around non-resource stocks. Recession impacts demand for oil, for copper, for stuff like that. And while I believe that 5 years from now, we will have supply shortages in both of those commodities, in the nearer term, if a supply shortage is met by a demand shortage, it doesn't have much impact on price. And I'm not saying this as an economist. I'm not an economist. I'm saying it because I'm not sure that all of the laws around the business cycle have been reversed by Trump or others. And it's been a very, very, very long time since we were slapped by reality. As a lender, which is my primary vocation over time, I'm always slap averse.
He mentioned something that was interesting there, Joel. So there's 11 sectors in the S&P 500. Are you seeing radical overvaluation in one, but under in others, or what are you seeing?
In general, we are not seeing overvaluation with the S&P hitting all-time new highs. I mean, right now the market is pricing in that earnings growth across all companies in the U.S. is about 7%. And yet we could show that earnings growth is actually closer to 9%, and that there's no reason that won't continue. Are there pockets? Yeah, but it's probably less sectors and more industries or even sub-industries. I don't like autos. I don't like office real estate. I think office real estate is still in the third or fourth inning of a long depression, for all kinds of reasons. I don't like banks that have overly lent to offices or autos. if you want to follow the supply chain, and then when it comes to the big Magnificent Seven, yes, they've gotten expensive, if you will, but when you're growing earnings, a PE of 30 with zero earnings growth is an expensive stock. A PE of 30 with a 15 to 20% earnings growth is actually a cheap stock, because within a couple of years, you're pricing in a 20 times or even a 15 times earnings number when you have that kind of 20, 30, 40% earnings growth. And we are seeing that with a lot of those companies, which, it takes us back to say, so we don't see those overvalued. In fact, the areas that are worst are the same metrics that we would use if we were looking at the economy as a whole as being a problem, which we don't see, which is credit, and specifically corporate credit. Yes, I think consumer credit, I wouldn't want to be holding a lot of student loans. I wouldn't want to be holding auto loans and certain other things. And so there's some areas of credit that are bad, but corporate credit is unbelievably healthy. The mistakes that companies made in 04, 05, 06, 07 wasn't just they took on so much debt, but it was almost like buying a house. Instead of getting a 30-year mortgage, they're like, oh, but I can get a cheaper interest rate if I just do a rolling 1-year mortgage or a rolling, 6 months, which really bit them badly. And companies that were technically solvent, like General Growth Properties, one of the biggest mall owners in the United States, the second biggest, their problem wasn't that they had too much debt. The problem is it was all coming due every 3 months, or a lot of it was coming due every 3 months. And when the banks and people stop lending, then everything comes to a grinding halt, no matter if their assets grossly exceed their debts, which they did. They probably were 3 to 1 on assets to debt. But when it's all coming due, because you're trying to edge out that little bit extra earnings and mismanage your balance sheet that way, which a lot of companies are doing. I'm picking on General Growth Properties, but it was happening across all 11 sectors. Companies are doing that. Management teams have gotten very, very, very smart about that. And so that's one of the reasons I think, Rick, that we've seen such a long bull market is companies have been a lot more disciplined over their balance sheets than you could measure going back 50, 60, 70 years.
I remember Michael Milken talking about this at his conference, one of the few conferences in the world that rivals mine, and saying that you had to, as a lender or as a borrower, manage both solvency, which is to say you couldn't be over leveraged, but you also had to manage liquidity.
Yes.
That if you had reasonable earnings, that you could be more leveraged than the norm, assuming that you had a relatively high working capital balance, and that the maturity of your debt was workable. I'm delighted to hear you say that, frankly, Joel. When I look across the economic landscape at what really truly scares me, what a black swan would be, it's the proliferation of non-investment grade credits in ETFs. And the fact that the Topco vehicle, the ETF, is extremely liquid, owned by Ma's and Pa's, who don't understand anything about the bond covenants of the product in the ETFs, and the underlying bonds themselves are anything but liquid.
Mm.
I remember that the writing was on the wall pre-2008 around real estate credit, but it didn't happen until it happened. And my real personal black swan moment, and I would love you to allow me to sleep nights by dissuading me from this fear, is that we have a broad feeling of credit contraction, and the Ma's and Pa's who own the ETFs elect to sell them. And the managers are forced to sell the underlying instruments to fund redemptions.
Mm.
And as we used to say in the 1980s around illiquid corporate bonds, they become owl bonds, where the seller calls the broker and says sell, and the broker says to who?
Yes.
To who?
Yeah. Right.
If, as you suggest, the underlying credit quality across corporate America is better than I fear, then perhaps the structure of the debt market, where so much debt is held in ETFs with the ultimate lender, the shareholder, being unsophisticated, perhaps I can worry less. Any comments?
Yeah. One of the things we've seen is, particularly with commercial lenders. So commercial lending, the senior loan officer opinion survey, in pretty much every one of it, since they've been doing it since the 60s, every time the senior loan officer survey of the 60 biggest banks in the U.S. Spikes in terms of massive tightening of credit, we have had a recession, except for the last one. And what we saw in the last one was that when you say to whom, who's going to buy that credit, we saw private equity move into private placement, whereas maybe 15 years ago, private equity would have $200 billion of lending. Today, it's close to $3 trillion. And at those numbers, it is enough to make up for it. And that's what we saw. And we actually have to continually expand our understanding of what is corporate credit, because we never would have thought that KKR would be a lender of last resort. Now, it's not great for the company if they're paying 13% or 15% instead of 6 or 7 or 8, but it does forestall the bankruptcy ripple effect that occurs in every recession. And as long as they seem to be a lender of last resort, I think KKR did a very good saying they and their peers had stepped in, had been stepping in, and that probably saved us from what could have been a much worse bear market in 22, 23, called 23, where the S&P did drop, but it didn't maintain a long sustained bear market, because you did have a lot of money coming in that did not come from those other, I'll say, alternative sources before in that amount. If I'm answering your question, Rick, in terms of the where we saw to whom, someone popped up, they said, but I'm going to charge you a lot more interest and put all kinds of governance. And this is not light paper. This is very, very debt, covenant heavy paper, but that may be a good thing for some of those companies, because it got them to discipline themselves.
I wish that some of that paper in industries that I understand would come to me. The paper that comes to me seems to be more covenant light, which is why I'm so long cash. My traditional business is as a private lender.
Yes.
And I'm frankly delighted about that availability of credit. I'm always nervous, perhaps because I can't do it, about the ability of the masters of the universe, the KKRs and the BlackRocks and others, to understand 300 industries. Just like I've always been concerned about the folks at Bank of America or JP Morgan Chase. Perhaps that's because I can't do it. But I am nervous about misallocation. I get your point about the fact that if there's $7 or $8 trillion in high yield papers in ETF, if there's $3 trillion in liquidity elsewhere to take up the marginal selling, that would be a good thing. I look at some of these underlying bonds, at least the ones I'm familiar with, and I notice bonds that change hands every 4 weeks. And I am concerned about the liquidity in the non-investment grade credit markets. And I am, as I say, reminded of second year university when they told me, as did Milken, I have to concern myself with both solvency and liquidity.
Yeah.
Can I just kind of summarize here? So basically what you guys are talking about is like borrowing short and lending long. That's
one thing. That's
okay.
one thing. That's the classic bankers or savings and loan conundrum.
Yeah.
A
What
tremendously
Signature did
foolish,
and what
tremendously
Silicon
foolish
Valley
thing to
Bank.
do.
Silicon
Yeah,
Valley
Silicon
Bank.
Valley Bank, exactly. A wonderful
Yeah.
bank that made a stupid headline decision.
Yeah.
I'm talking about something else, though. In addition, I'm talking in the ETFs about tremendously liquid vehicles at the top that own less liquid assets, and a shareholder base that doesn't understand very much about the credits that they ultimately hold. Which is to say, the liquidity mismatch between the top co and the portfolio, and a separate issue, which is to say the ability of these money managers to understand credits in many industries. As I said at the outset of this interview, there was a time in my life when I thought my success in investing meant that I was a good investor, not that I knew something about natural resources. And when I ventured outside of the area that I had developed my expertise, I found out just how good I was, which is to say, not very. I wonder how much worse I am than some of my peers in money management today who have a broader opinion of themselves.
Okay.
Yeah, that's interesting. You know, we the Altman Z-score, Ed Altman created this, default score based on financial analysis. The problem is Bloomberg and everyone are still using the calculations for the Z-score that were created 30 something years ago, and the accounting has changed so much in 30 years that you could argue it's not the original default analysis isn't relevant anymore. We built our own version of a Z-score, which we just express as a credit default swap, but an intrinsic CDS, if you will. And then we calculate that on every company, whether it has a traded CDS or not. The traded CDS markets would say the debt markets are very healthy and safe, if you will. But even our intrinsic CDS, which we apply on every company, now that's the US. In China, we run an intrinsic credit default swap score, and we do bank risk on 6,000 companies in China. And if China had the same bankruptcy laws as the United States, 1 out of 3 companies in China would be in bankruptcy as of right now. 1 out of 3 publicly listed companies, 2,000 of the 6,000 roughly, would be in that. So yes, I'm saying in the U.S. we see things that are safer, but in other parts of the world it's nasty. It's a mess.
Now, Joel, I want you to take that ratio. I want you to take the first part of what you just said and pretend you're not talking to me, but say it in English. Tell me exactly what it is that you do, how those ratios work. When you say CDS, say credit default swap, and tell people what that is.
So, the credit default swap is actually one of the best named securities because it is, what does it cost to swap the risk of default on the credit that you've given someone? And so you loan someone, right, to insure it. And so we actually calculate the pricing of that intrinsically, and it's based on a bottoms-up analysis of the financials of a company, and it's based on liquidity. It's not just based on, is it solvent? It's based on the company's earnings. It's based on a uniform calculation of earnings, which the statement of cash flows unfortunately doesn't do. It's unfortunate the statement of cash flows is no longer a statement of cash flows because there's all kinds of non-cash items in it. And so if we simply say, let's get a real cash from operations number and a real cash on the books number and compare those two things to the company's debt service. And if we do that in the United States, maybe I have 1 or 2% of our entire database of, call it, 3, 4, 5,000 companies in the United States that have a bad looking profile. Let's say it that way, right? Or a more near-term risk of default. When we do that in China, and it's really just a head wall. We just say, here's the debt service required, and here's the cash from operations you have. And if it's lower than that debt service, there's a problem because it means they got to get the money from somewhere, or they're into an extend and pretend, which a lot of regional banks are in with some offices and some autos, but meaning in the United States. But in China, it's every sector. It's in every one of the 11 sectors. You can find tens, if not, hundreds of companies that have a serious problem from that standpoint. And honestly, that and what we see in other parts of the world is another reason why we'd say you'd be very bullish gold, because every Chinese person would say, I'd rather own gold than own, these securities. Or if they could, I suppose they try to get U.S. equities, but China makes it quite difficult for a Chinese individual or family to do that.
Yeah. So why is that? Why is it that China, they haven't gone bankrupt over there? They just have different rules and they just keep the can kicking down the road? What's the reasoning?
Well, if the banks are owned state-owned banks, and the banks are the ones that would put a company into receivership, and the Chinese government says, if you put that company into bankruptcy and chop up the company, you're going to fire those 800,000 people or 200,000 people or whatever. And the last thing the Communist Party wants is political unrest. That would be a big reason they tell the banks, extend and pretend. Don't let them pay their bills, let them pay their payroll, and tell them just make your interest payment, and we'll settle on the debt service, the principal payments down the road. And that down the road, it wasn't just the pandemic. I mean, this was already happening in 2018, 2019. The pandemic made it a lot worse, but it's not like the ending of the pandemic made it any better. Again, we see that not just in China, but in a number of countries. We don't see that in the United States, which means you could be bullish on gold for that kind of crisis and those kinds of problems. And you can be bullish on U.S. equities because U.S. equities are in such a good state for those same types of metrics.
Okay. And Rick, your concern, like when you mentioned the ETFs, are you thinking like GDX or something? Like it appears very liquid.
I'm talking about the high yield ETFs that principally own below investment grade bonds. There's a whole posse of what I impolitely call yield whores, retail investors who are chasing yields, trying to get 150 or 250 basis points more than they could get in conventional savings products by owning exchange traded funds whose assets are denominated in sub-investment grade bonds. I have talked to a couple hundred of these retail investors in the course of doing portfolio rankings, among other things, and I am appalled their lack of knowledge around credit. I'm delighted to hear Professor Litman say that there's another pool of capital, somewhat more sophisticated, who might be able to run to the rescue. When I looked at things that could, in my view, be the black swan, could be the trigger for liquidity events like those that we experienced in 2008, the one that scared me the most was the mismatch in liquidity between the high yield ETFs and the underlying assets that they owned. And I need to say, when I thought about it, it really scared me. So I'm delighted to be a little less scared. At my age, Steve, I've had all the caution I need in my life.
All right. And Joel, when you're talking about corporate credit, you say you're not seeing the risk like we've been talking about of borrowing short and lending long.
No, it's just saying in general across all U.S. corporates, the debt levels are higher than they were in 2007, but the debt servicing and the way that's spread out over not 6 months or 1 year where they're constantly refinancing, but where they said, all right, we'll take a slightly higher interest rate, but we're going to spread that over the next 5, 6, 7, 8, 9, 10 years. Has actually been, I'd give the CFOs of U.S. corporates, an A- to an A on what they've done compared to what they did, which, was clearly a D or an F in 2007. That's it. It's not just the amount of debt, it's the debt structure. And when we look at all our U.S. equity database, which is also in total, not that we put it all online, but the total that we use just for our macro research of called 7,000 U.S. companies, it's a very, very small percentage where they have debt head walls that look unserviceable against the cash flows and cash on the balance sheet of those companies.
Okay. There's more debt, but they can afford it.
There's more debt, but the debt servicing is low enough and spread out over many, many years as opposed to many, many months. And that gives them a lot of leeway and time to refinance, and everyone can see the debt head wall coming 2 years from now, as opposed to everyone's debt head wall is coming in June of 2008, which is what it looked like. This kind of analysis looked like back then. It was like, how is everyone going to refinance the same month when the lenders don't want to refinance?
Okay. That makes sense. So maybe we could take If you guys had to pick one, the S&P or gold, what? I think I know what you're going to say, but Rick?
Well, for me, it would have to be gold because I don't understand most of the components of the S&P, and I no longer invest in things I don't understand. I invest in natural resources broadly. That includes farmland and timberland, and conventional financial services, not fintech, but rather banks, wealth managers, asset managers, and insurance companies. That excludes most of the S&P. So I don't invest in the S&P. My general market securities portfolio is constrained to banks, property casualty insurers, and Berkshire Hathaway. I don't I don't feel up to competing with Warren Buffett, particularly given that he gets to set policy loss reserves at any level he wants. So he's become a prior taxpayer. I can't compete with that. So I think I do understand gold. I'm probably more concerned about the total finances of the U.S. federal government and the implications on that for the dollar than Professor Litman is. And the consequence of that is that I feel more comfortable with my gold position than I otherwise would. But at least I have a considered opinion. If I had an opinion with regards to the S&P 500, which is to say, if I was trying to analyze retailers or automobile companies or chemical companies or supermarkets, I'd be lost. So I don't do it.
Okay. Joe?
Yeah, I would suggest that the question is an unfair question because I wouldn't compare gold stocks or precious metal stocks to the S&P. I would say the S&P is your starting place for a risk. And if someone said to me, I'm going to put $1,000 away in my 401k and I'm not going to touch it for 40 years, and I want to spend zero time thinking about anything for those 40 years other than my job, I'd say you're going to do very, very well in the S&P 500 over time. Now, if
did you say 40 years?
Yeah, so they start at 22 and they're going to, by the time it's 62, and you're just going to leave it in for that kind of length of time. Now, would I ever recommend someone to only? I mean, I wouldn't have a stock picking service if we didn't feel that they should be replacing VOO piece by piece, and we tell them, somewhere between 30 to 50 pieces of the VOO should be chopped up and then put into the stocks that we recommend. And I would be happy if someone said, well, I've got 10 ideas from Rick of certain stocks and certain ETFs that I'd like to put in. And I'd say, and if the research behind it's really good and you have the time to pay attention, which is not that much time really, but you do have to pay attention. You can't just fall asleep for 40 years. I'd say you should be replacing VOO with those items. That said, in the last 20 months, this is going to sound like I'm bragging, but in the last 20 months, I'm going to sound like I'm bragging and then I'll prove that I'm not. In the last 20 months, we've recommended 20 stocks to our clients that have more than doubled. Well, we'd say 20/30ths of their VOO position should not have been VOO. It should have been in the 20 stocks that we were recommending that doubled, right? Now, what about the other 10? I'd be happy if they said, I've got 10 precious metals, gold positions that I'd like to put it into. If they said, I'm just going to put in gold outright and just one gold ETF, I'd say that's probably not as good as getting into specific gold miners or something. Like Newmont has done very, very well and blown out earnings. And in that case, you actually have companies you can study for earnings and for gold and for whatever else. And I'd say I'd be happy to replace it. So it's not S&P versus gold. It's S&P if you're 100% passive and you're going to do nothing else. But if you have a little time, should you be replacing your S&P position with specific issues, which could include gold issues or could include other precious metals or commodities, or the 20 stocks that we recommended that went up more than double? I would say, of course, you ought to be doing that. And those things, with the right research, should outperform the S&P handily. Some of that is gold.
Okay, that makes sense. The cyclicality of gold is what would keep you from wanting to throw it in there for 4 decades.
For just leaving it in there for 20 years or 30 years. Yeah, I think that would, as soon as you start saying, I'm going to take it out of the S&P and put it in somewhere, that requires time and effort. And some of my clients are like, I just want to know what to do with my 401k. I'm like, and I don't want to spend any time reading your newsletters or whatever else. I'm like, all right, then put it in VOO and let it ride, and they'll do very well. They do a lot better than if they let it sitting in a money market or a bond fund. Rick, as you were saying, I wanted 100% in VOO, in the S&P 500 or SCHB at Schwab or something like that, for a purely passive. But the second someone says, I'm willing to do a little time and a little research and spend a little time, well, then of course I'd be replacing the S&P with other, I'd say, investments, but those investments require paying attention. That might be 3 years or 4-year holding period, but I'd still say you got to pay attention.
Okay. I like the 40-year number better, Joel. One of the things that I've noticed is that most investors make a mistake of studying too little and doing too much. Yes. There's a famous study that may be apocryphal that allegedly Fidelity did, looking, slicing their universe of investors by all sorts of things: gender, race, economic status, profession, looking for subcategories of investors and how to market to them, and what they did well and what they did poorly. And it is alleged that the best performance category that Fidelity had in its universe was dead people, estates, who simply did nothing. They didn't trade the latest fad. They didn't pay capital gains tax. They weren't in and out of things. And when you preceded your talk by saying 40 years, Buffett said he got rich by being a little cautious and becoming old.
Yeah.
And people need to understand that you need time to compound. If the S&P sells off by 30% or 40% and then goes up by 8 or 9% a year for 20 or 30 years, the downticks are ugly when they occur, but they don't matter over time. I've looked at my own holdings of Berkshire Hathaway, which go back to 1982. And I can't remember if it was 3 times or 4 times, but 3 or 4 times in that period, over 18 months, the stock has declined by half. When you go through that, it's disquieting.
Yes.
But when you look at it in the period 1982 to 2025, you can't see the drops on a chart, which is wild.
Yeah.
What I hear you guys saying is that you're basically sticking to what you're good at and your strengths. And Rick, for you,
make time on your Steve. It's important that people understand that you got to make time on your side.
Yeah. Let it do its thing. Try not to. Sometimes less is more.
Every kid in the U.S. by the age of 15 should be taught that if they put $1,000 away when they start working every month, then in about 20 years, that'll be $1 million. And if it's a 401k where the company matches half, then you only put $500 away and that'll be $1 million. And because it's pre-tax, you're actually only hurting yourself by $350. So for $350 a month, you're going to have about $1 million in 20 years. And so at 42, you're a millionaire, right? As long as you get started. But so many people, right, they just, and that's just purely passive. That's just purely passive. Now, someone said, well, I'd like to do better than that. I'm like, well, then you should. And if you put some time in and research into, then I think, some of the I'm just going to say the investments that I hear at the Rural Symposium that I know nothing about have done very, very, very well. But they require you paying attention when you buy, and they require you paying attention to sell when it comes time to sell. And the same with any individual stock, I'd argue. There's no individual stock that I'd say this is like AT&T, you can ride it for 20 years, or GE, like back in the day. Look what GE has done, since it's fallen on some problems. But there's always a company to replace it, which is why, purely passive S&P 500. But the second you start saying, but should I do more than that? I'm like, yeah, and some of that could be gold related, and some of that are stocks of any kind and sector, and not all, of those companies that are up so much. One of them, of our best ideas, Hyatt, Build-A-Bear, Primoris. These are companies that are not Nvidia's or trying to make a bet on the next iPhone or whatever. These are just good, solid companies that are smaller, that Wall Street in many cases doesn't cover because they don't get enough banking business. Wall Street, research is still atrocious. And yet you just turn around and you're like, good, strong earnings, good management, good governance. You'd ride it. But at some point you're like, yeah, but then I'm going to sell it. I'm going to put it back in the S&P or into something else. If I don't have time, I'll just put it back in the S&P.
Okay.
It's a parking spot. It's not a S&P versus gold, even though sometimes I'll say that. There are times where I think gold has done very well, and in the bull market that gold's in right now is quite impressive.
Yeah. Okay. So Hyatt and Build-A-Bear, those are two that you like right now. What about you, Rick? What are some opportunities that you're seeing? Are there any deals out there that you think no one's paying attention to?
I've been just in the last 2 weeks pretty aggressively selling some of my junior stakes. I had anticipations of what I thought they might be worth a year from now, and they're trading higher than what I thought they might be worth a year from now. We talk in the real classroom about the process of answering unanswered questions and what a yes answer is worth. And I've been getting some valuations that presuppose a yes answer before the question has been asked. In that circumstance, where the enterprise value is substantially higher than my anticipated NAV, I sell. The easy money in the juniors, the kind of stuff that you see at the conference, is when they progress from hated to liked. They don't need to be loved. That's the really easy money. When you see uranium juniors that have decent, perhaps out of the money uranium, but they're selling at a 40% discount to cash. And all the geniuses on the internet, the people with uranium as part of their internet handle, are saying that these are pieces of trash, nothing, nowhere, going nowhere. That's just a lay down buy. The last 2 weeks have been positively frothy among the juniors. And I felt, given that I've inhabited the space for 3 or 4 or 5 thankless years, that it was time to get paid and get paid handsomely. And I'm delighted to say that my sales to date have paid the capital cost of the entire acquisition of my junior portfolio. It's been, and you know what? I think they're going to go up from here. I think October is going to be a very good month. And I could care less. I don't care at all about leaving money on the table. I really, really, truly believe at age 72 that you can have some of my upside if you take away most of my downside.
Yeah, there's been some amazing runs. I've been clicking the sell button quite a bit too. What about deals? Do you see any deals right now? I still see nickel looks like the VIX right now, like a dying heartbeat. Do you anything?
I think the overriding deal in the resource business is oil and gas.
Okay.
The market's priced like Joe Biden and Justin Trudeau were right, that the half-life of the oil industry is 2032. That's ridiculous. Peak oil demand, never mind, it doesn't occur in my life. It doesn't occur in Professor Litman's life. And when people do the net present value calculations, they're cutting off the whole tail. And the net present value tail is 30 or 35 years long. So the relationship between price to value in the resource business is oil and gas, oil and gas, and oil and gas. That isn't to say that those stocks are going to outperform sectors that enjoy more favor right now. But if you invest the way I do, enterprise value relative to net asset value, it's all oil and gas.
Okay. Do you have any follow up? You've got a program, Joel, where you can plug these things in and it runs. Any stand out there from what Rick just said?
The enablers. So there's a company that it's called Bloom Energy. That's another one of our favorites right now, and it's ticker BE, Bloom Energy. And what they're able to do is take natural gas and co-locate a fuel cell right beside wherever it's needed. It's a small platform, and so you can have energy there. Also, it's super clean. The gas doesn't even burn when they convert to electricity. It's actually a electrochemical gas plus oxygen and hydrogen that actually turns into electricity without ever having it burn. It's an electrochemical function. And so when you look at that level of clean energy from gas, where you're not even worried about it burning off at all, because you're just using it that way. and the ability to power the energy needs of the U.S., which are growing far faster. I have a friend that says there's no grid fairy. Like, people just assume that when companies need need energy off the grid, it just appears. And he's like, no, it doesn't. And we're going to find the companies that, selling electricity to residents, that's government regulated, has never been a great ROI business, because your costs go up and your prices can't. But when you're selling the market to the hyperscalers, to the Googles and Amazons and Metas of the world, suddenly you get pricing that's at market. And those market prices for electricity, which you need gas to provide, because nuclear is still 5 or 6 years out before it's going to solve the real energy problems the U.S. has, and solar is too, without the batteries, is still a little too flippant. Natural gas is the great thing, but we'd say, why go natural gas by itself when you can go into natural gas related stocks like Loop Energy that's doing something gas that's really amazing and providing it right when people need it, and buy that kind of a stock to express. I mean, similar, it's just because we have a call on energy going up doesn't mean we're saying go and buy energy. We're saying go find the stocks that get you a better expression of that, and maybe with more reward and less risk.
Interesting. Have you heard of that? Oh, sorry, go ahead.
BE being one of them. Yeah.
Okay. Have you heard of that company, Rick?
I have. And I've chosen to remain stupid, in the sense that I do extraction well. And when I get beyond extraction to beneficiation, looking back at my track record over 50 years, it's not as good. The smartest energy investor I know is a young guy named Darren Maupin. He used to run oil and gas analysis for Fidelity. He manages money on his own now. It's really, really, really good. And he has moved pretty substantially into the oil field service stocks. Mm. And my temptation has been to follow him if I like oil and gas. It's just that when I look at my own track record in oil field services over 50 years, let's just say it's spotty. And so I own Halliburton, I own Schlumberger, because when I talk to people in industry, they say that they hire those two companies irrespective of price, as a consequence of the service, the value of the service that they offer. That sounds like a pretty good business to me. And I'm buying those businesses with great balance sheets and relatively low free cash flow multiples. More sophisticated investors are able to do more qualitative and quantitative securities analysis in other parts of the value chain than I do. And so I don't do that. I try to do what I do, which is understand recycle ratio and net present value better than my competitors upstream, and limit myself to that.
You stick to your strengths.
Well, I mean, on that note, that is an issue, because the accounting in oil and gas companies is a mess, and FASB has made it more complex and more difficult. And they say, oh, we're there for the individual investor, but the financial statements.
Yeah.
Even looking at GM's financial statements in 1919 were 19 pages long. Today, and with 12-point typewriter font, right, and nothing smaller. And today it's 400 or 500 pages long, and you've got 6-point font on a lot of the pages, right, and the footnotes and everything else. And you're like, so how is an investor supposed to be able to dig through all that to understand whether or not it really is a good balance sheet, or whether or not the company really does have good credit, when the main statements, like the statement of cash flows, is not a cash from operations is not cash from operations. Cash for financing is not cash for financing. And yet an individual is supposed to be able to just look at that and say, I can figure that out. It's really difficult.
Well, certainly what Buffett says applies to the oil and gas business, which is that you read the financial statement backwards. You start with the notes, then you reread the notes, and then after that you read the financial statement to see how well it conforms to the notes. My good fortune, I guess, is that I've spent my life as a lender. I started as an oil and gas lender, and that means that most of the financial statement you ignore. Particularly things like market-related modification to the reserve statement. Mm-hmm. That's fiction. It really, truly is fiction. And, as a lender, I've learned that even the high-quality reserve reports if you're going to put any real money in, you have to verify. I commissioned a reserve my report once where one of the top 5 reserve consultants in the world miscounted the number of wells. If they get the headline number wrong, you can imagine what the bottom line number is. I think the lesson there is that if you strive for perfection, if you strive for certainty, you're going to be disappointed. You need to leave very large margins for error. And if you don't have sufficient margin for error, you pass.
Yeah. Yeah. Ben Graham's, one of the chapters in Intelligent Investor was called Margin of Safety, and then wrote a book, and the entire book was called, the title of the book was Margin of Safety.
Yep.
Seth Klarman at Baupost has been a phenomenal, long-term investor going 30 years plus now. And that you're always going to have some margin of error no matter what you're looking at. And so you want to say, I'm not going to buy a stock because it has 20% upside. I need a stock that's going to have the potential at least for 100% upside. And if I get it wrong, I'm still okay. Right. Yep. And then on the downside, I also want to be able to do the downside analysis and say, in the worst case scenario, could this stock fall 90% or it could fall 10%? And you want that asymmetric, reward versus risk, which are hard to find, but that's why you're only, buying 30 to 50 companies in a portfolio, because you're not going to find 300 of them that look like that.
Yeah. Yeah. Just a quick shout out to everyone in the comments here. Don, James, we've got Helen, and we have a question. Oh, hi. Hello, Ash. Good to see you. And a question here from Han. Hi, Rick and Joel. Is there any correlation between M2 money supply that keeps going higher around the world and higher stock market price that we are seeing now? Thank you.
I have no earthly idea. Joel, over to you.
To the extent that money supply is measuring, and then I'll say the velocity of money, just the amount of money that's out there and that's changing hands, or the amount of credit formation that's creating a lot more money, that does have an impact on inflation. And generally speaking, more inflation is bad for stocks. I mean, that's just it, right? The more you have lower inflation, the more you see stock markets do well. Inflation, I'll say, and taxes. The more the government takes your money, I'd say that's probably a big one. And people would say, like in the 1970s, was stagflation period, but yes, but also the government raised the marginal tax rate on Americans above 70%. And I argue that was a bigger factor than even the high inflation, stagflation at the time. It probably should be called a tax stagflation concern. Interestingly enough, the two kind of go together at times, and they do go together in many parts of the world. And so I'd say, looking at money supply, and maybe not just the M2, but just saying in general, do I have an inflation issue and do I have a taxation issue? And when the two combine, you have bear markets that go 5, 6, 7, 8, 10 years, wherever you are in the world, let alone what we experienced in the 1970s.
So you're saying the more inflation there is, the worse it is for stocks?
Yeah, I mean, people would say sometimes that the stock market goes up, because, well, the stock market's going up only because there's inflation, so you should inflation adjust it. I don't know. You go back to Ben Graham, stock market goes up because of earnings. If earnings are up, real earnings. If earnings are up because they're inflated earnings, which happens because in the accounting, if I'm depreciating an asset that I bought in 2010, I bought an asset that lasts 30 years, I'm still depreciating in 2010 dollars, but I'm making money in today's dollars. But the replacement cost of that asset, when the replacement of the CapEx comes due, is not in 2010 dollars. And so you literally have a 2010 inflation number with a 2025 revenue number, given all the inflation we had, and it can make it look like companies have earnings they don't really have. If we get to real earnings, which is the point, and real earnings growth is there, stocks go up. If it's inflated earnings, accounting earnings, if you will, because the accountants do not adjust for inflation at all in anywhere in the financials, then stocks go down. And I'd still say that at the end of the day, it's still real earnings that drive stocks up and down, in any market, more so than looking at just general inflation.
Steve, I want natural resource investors to think through what Professor Litman just said, because it says a lot for capital intensive businesses in high inflation environments. He described a negative. A positive is that if you're looking at increased supplies, say copper, and a copper mine cost $4 billion to build in 2010, that same copper mine might cost $15 billion to build now. The fact that you don't have to buy it means that existing inventory with long reserve lives are much more valuable than people believe them to be, because the replacement cost that faces investors is very different than book.
Okay. All right. We're getting close to the hour here. Do you guys want to go your closing thoughts?
Well, I mean, Rick, we're going to talk macro in U.S.
Well, no, we don't have time. I think what I'd love to do, given that you've made me feel a little better, for which I thank you, about the mismatch around high yield ETFs, is that we schedule another visit where you can talk me through why $130 trillion in net present value of entitlement obligations and $37 trillion in on-balance sheet obligations shouldn't be a concern
Not right
to an
now.
old guy like me. Pardon?
Yeah, not now. I mean,
I
not right now.
understand.
Not for the next few years, but it could. I mean, it could be. It's just not yet. And
Well,
and
I think that we should schedule another hour to have that. I would love the Litman palliative to make me sleep nights and stay strong. Sleep strong around the U.S. dollar and what I see as fiscal challenges facing the U.S. government.
I love it, and I'll share the data I have. I think
Great.
we probably line up a lot more. It's much more of probably a when than issue that we might disagree with, as opposed to if.
You're failing, Joel. You're supposed to make me feel better.
But when could be 30, 40 years from now. So.
Oh, well, that's okay.
Oh, okay.
To hell with the
I
kids.
may see it, I may not. Awesome. Well, thank you, gentlemen, very much. We have a Q&A coming up. Rick and I will be on. We'll be taking your questions, and Rick will be answering them in 2 days' time on in the Rural Classroom Plus. And Joel, you and I are getting on my show in 2 days' time, right after that, and we'll be taking questions as well. So thank you very much, gentlemen. This was a lot of fun. Any other sign-offs?
Thank you all.
Thanks, Rick. Pleasure being on. Thank you. Thanks to the Rural Classroom, Steve. Thanks for moderating today.
Yes,
Pleasure.
thank you. Thank you for having me.
We look forward to hosting you next year in Boca Raton. It's going to be a better show than this year, and this year was pretty good.
Yeah, it was fun. It really was. Looking forward to it.
Good deal. Okay, well, thank you, JC. If you could close us out, we will talk to you guys again on Thursday.